Hi guys, it's Winnie here. In this video, we're going to talk about how to manage your family finance in 2022. We're experiencing high inflation, surging cost of living, and also increasing interest rates. And we all collectively feeling the pain right now. Many economics and also investment experts already warn us in upcoming recession. So you should be really cautious on every financial decision you make. I made a video about 7 money traps people make and you should avoid in 2022. So you can go and check it out later. And in this video, I want to provide a little bit of background of our current economic situation we're in. Not only you get to prepare yourself well, but at the same time, you can also build your own financial judgment. Please subscribe our channel to get weekly update for tips and strategies on mastering your family finance. Where we're right now is a combination of many factors in our global market, and all affect each other and compound into this challenging situation we're in. So let's talk about the very first thing, which is post-pandemic era, cost of living surging. To understand about this situation, we need to start from the basic, supply and demand. We live in a life with supply and demand. In other words, exchange. Some people provide something and others are willing to take it with a agreed price in exchange. And you see these transactions in our life, whether it's in essential needs, any service provides, or in any investment markets. When the supply and demand is balanced, we see a healthy upward trend. Happy days for everybody. But when the supply and demand is imbalanced, that people demand more than the supply chain can offer at the time, supply had the bargain power to increase the price. Subsequently, people have to pay higher price to acquire the goods they need. On the other hand, when the supply is more than the people demands or need, the market is flooded with options for consumers to choose from. Now, the consumer get the bargain power to negotiate the power getting lower. Otherwise, they can go somewhere else. In 2022, we see an extraordinary high demand for goods, and this demand overwhelmed the supply chain. And when the demand is greater than the supply, you either get shortage or you get the price increased. And this is exactly what happened in the last 2 years. The rise of inflation is being largely driven by during and post-pandemic demand. And on top of that, Russian invasion of Ukraine pushed the food and energy prices hitting record high. As Ukraine is the 5th largest wheat producers and also the largest sunflower oil producers in the world, while Russia is one of the world's top energy producers and is still the home to approximately a quarter of the planet's known natural gas reserves. The ripple effect for this is our essential needs for food, transportation, electricity were impacted directly. And of course, subsequently, other services or goods that business require to provide service increased as well. Hence, other parts of our life are impacted too. The pandemic impact is not over yet, and we're still living the tail of the overall economic consequences. At the moment, US is experiencing the highest inflation rate of 8.5% in 40 years. The monthly food price index from the UN's Food and Agriculture Organization, FAO, which tracks the prices of global traded food commodities, also reported of 12.6% between February and March to reach the highest level since its inception in 1990. In Australia, we are currently having inflation around 4 to 6%. So, as we said, the demand is higher than the supply, increase the price of goods. Hence, we see the price goes up. And with the Russian invasion to Ukraine and other factors, the cost of supplies increases. Hence, we're experiencing the high cost of living overall. That leads to the other parts of the story. High inflation rate leads to increasing interest rate. And first of all, we need to understand what inflation is, how increasing inflation is impacting our lives, and who and what can do to balance things up. Inflation, simply put, is a general increase in prices of goods and services in the economy and decrease the purchasing power of money to acquire goods and services that we need. For example, some of our food, as we said earlier, has increased the price about average 12.6%. So if you spend on $500 in grocery weekly before, you now have to pay $563. It's a $63 more weekly for your family needs. Another example is the housing price. The global home prices rose at its fastest rate in almost 18 months in 2021, with price across 150 major cities seeing a 10.3% average rise. So if you were aiming to get a $500,000 worth of house, you now have to pay average about $550,000 or more, depends on which part of the world you are in to get it. So inflation is not only increasing the price of goods, but also lower your purchasing power and lower the value of pensions, savings, and treasury notes. Assets such as real estate or collectibles usually keep up with inflation. And now it's even harder for the home buyers to purchase their dream homes, as we've mentioned earlier. That's why the reserve banks, Federal Reserve in each country need to take some action to control the economic activities in the market, slow the inflation down, and bring the stability to the economy. The common monetary policy is to increase the interest rate. Why? By increasing the interest rate, it increases the cost of money you borrow to acquire goods and services. In other words, the higher cost of money reduces your purchasing power. Now, because the cost of money you borrow to acquire goods and services are higher, you will think twice on whether you can borrow and also buy those things you want. Hence, it effectively makes you buy less. With decreasing demand, as we said earlier, the suppliers are unable to increase the price. Now, you see the price goods and services are down, and it also slowed down the inflation. In Australia, our current inflation rate is about 4 to 6%, while our target over the medium term is 2 to 3% on average. That's why you see Reserve Bank in June 2022 just announced the first back-to-back rate rise in 12 years with 50 basic points, from historical low of 0.01% to 0.85%. And the experts has predicted that cash rate will increase to around 1.75% by the end of 2022. All of the monetary policy in place is to ease the inflation. The consequences now is, as we said earlier, the cost of money to acquire goods and services is higher, which also means that homeowners, investors like myself, and also my family, and all borrowers, be prepared for the higher monthly repayment to come. So give you an idea, let's say a $500,000 loan. Now the monthly repayment will roughly increase by $133 per month. That makes the household budget even tighter now. So if you already foreseen the increasing on the borrowing money, what you have to be mindful now is to reduce any consumer debt as much as you can. And those consumer debts are credit card debts, personal loans, car loans, and even with your mortgages. By reducing unnecessary costs of the interest you pay for the loans, you get to free up the money each month to put them aside. So now you can build your safety net, pay down debt sooner, and have the adequate funding ready when the right investment arrives. So to sum up, to prepare the potential recession to come, make sure you are reducing all consumer debts, building up funds for the right moment to come, and also equally important, starting to build your financial muscles and judgments with financial knowledge. So I hope this helped you prepare the challenge to come and manage your family finance accordingly. Thank you for watching today, and please like, share, and subscribe the channel to get weekly updates with tips and strategies to master your family finance. And I hope to see you in the next video. Bye.